Hey guys, Brian here. Hope your week's going great. In this video, we're going to look at what happens when investors get really excited about the tech sector. We're not going to just look at a decade or two. For this one, we're going back a century. Stay with me. All right, guys, welcome back. I am finally in Japan. They reopened in October. They got rid of all the COVID restrictions a few months ago. So this is really the first spring that everything's kind of back to normal. It feels busy. I got to say, lots of tourists stepping out of that metro in Shinjuku is just like stepping onto another planet. We made it to a bunch of the famous pagodas and temples around Tokyo so far. Plan is to be in Kyoto for a month, maybe hike Mount Fuji in July, and then probably a trip up north to Hokkaido. So I should have some good footage around Japan next few videos. I gotta say, I really love it here, and perhaps it's a good place to kind of talk about tech and what happens when investors pile into those shares. That's what this chart does. It comes from a recent report from Bank of America. It's a ratio between a tech index and the S&P back through the 1920s. This red dashed line is the average. Blue is plus and minus 2 standard deviations. And obviously, plus 2 here has been pretty important because those reversals marked big bear markets in the S&P. First one here in 68, cycle degree in Elliott terms, bear market lasted through 1982, though that's in real terms, inflation adjusted. And before it's over, all that tech excitement is gone. Same in the dot-com era. We jumped to 2 standard deviations, major top, S&P drops 50%. The tech bear is even worse, and the ratio ends back near that long-term average. Here we are again today, except that this ratio has been at 2 standard deviations for 3 years. It's bigger than 68, bigger than 2000, which makes complete sense because this top in terms of Elliott waves, it is at least a full degree higher. So this is a feature of wave analysis, right? It's a fractal progression. You can't just compare today with yesterday. You have to compare today with a specific yesterday at a similar degree of trend. In our view, tech is going to underperform again, and this ratio will eventually be back below its average. Now, if you enjoy this kind of analysis, we show all sorts of these kind of longer term charts in our newsletters. The links below will take you to our resources. Thanks for watching.